Welcome to Investment Ideas. I'm the host here today, Ed Harrison for Real Vision, and I have the distinct pleasure of talking to Lyn Alden, who is the founder of Lyn Alden Investment Strategy. Lyn, welcome back to Real Vision.
Hey, happy to be here and happy to talk to you, Ed.
Yeah, I'm very excited to talk to you. As I was just telling you, there's so many things that we can talk about, and you have a very distinct and cogent way of breaking things down. So I'm really excited to pick your brain for the better part of an hour.
Yeah, there's so much to talk about that it's gonna be hard to kind of keep things reined in, I think, more than the other way around.
Yeah, and what I would say is I want to start big and then hone in. So for those who are watching, what I'm thinking is I want to pick your brain first and foremost on the framework and how you're thinking about things with regard to precious metals, with regard to equities, with regard to cryptocurrency in the context of some of the things that are impinging upon us with regard to the yield curve, with regard to inflation and the fiscal monetary stimulus that we see. So I know that sounds like a lot, but let me start off with this. I think earlier today I saw in the morning that the yield curve had gotten to about 119 almost on the 10-year, and that seems like a resistance level. A lot of people have been talking about this. The fact that really when it comes down to it, it's very difficult to get yields to go up a lot before a whole nexus of bad things happen. And so even though we might think of the reflation trade pushing up yields as a positive thing, showing the economy in a positive way, actually it could lead to negative consequences. How do you frame that whole discussion?
Yeah, so a really big thing to kind of focus on, I think, is duration. And so if we see rates rising or falling, whatever our outlook may be, mine points towards higher rates. But whichever direction we see on that, that can affect market internals very differently. And so rather than just kind of looking at the broad index, my emphasis is on what are different sectors and different stocks going to do there. And so historically, these lower rates are very good for these kind of high growth, long duration assets, because if you look at the way discounted cash flow analysis works, if you discount cash flows, by a certain interest rate, growth stocks have a lot more, like a higher percentage of their expected cash flows far in the future, and so they're more sensitive to the discount rate you use, whereas value stocks pull a lot of that growth forward. They're at lower valuations, and more of that cash is kind of front loaded, and so as we've driven rates super low, not just over the past 40 years going onto this, but then especially this year when we kind of had rates collapse, we've seen this huge bid in valuations for all these tech stocks and growth stories. And of course, many of them are doing well fundamentally, which is why they're able to attract capital. But if you look at their stock prices going up relative to how their fundamentals are improving, a lot of it's a valuation story because people don't know where else to put capital with rates so low. They don't necessarily want to hold cash and bonds, but then they also have been hesitant to get in some of the more cyclical or kind of less futuristic plays, like say banks or industrials or energy. And so we've kind of had this crowding in effect at almost any cost into a lot of these growth names. And then to some extent, even the profitable growth names got less attractive. And so people poured into the unprofitable, hyper long duration growth names. And so what I'm kind of watching is if we were to see rates continue to rise, I think we could get somewhat of a continued rotation. And so if you look at the growth to value index, some of those are kind of showing